Hello and welcome. Today we're going to look at an interesting name because what this will likely do if they are able to pare down on debt is you will start to see large leverage start to play out. So I'd want to first know whether a Puravankara can do that. How quickly can they pay off their debt? Now the objective is that over the next 12 months or so they'll roughly pare down debt by 800 crore. But what's the impact of that with regard to interest cost and what could that lead to in terms of the financial re-rating of the company is what I'd want to know. So that's probably the first piece. The second piece is with regard to the debt picture in the medium term, because it's not like new launches aren't coming on stream. How are they going to fund those new launches? What is the kind of capex required with regard to the new launches and the debt reduction glide path in general? The third piece is with regard to the 5 land acquisitions that they've made in this financial year. What are the timelines for approvals? Because there have been instances in the past where approvals have gotten delayed, due to which, of course, there's an impact on both cash flow as well as on launches, and therefore you want to understand whether there is some amount of visibility with regard to that. The fourth piece is with regard to the new launch pipeline. How large is it? Because Q3, Q4 was supposed to be a strong year, strong couple of quarters for launches. Whether we'll expect that kind of launch pipeline to come through over this quarter is what I'd want to know. The fifth piece is with regard to the current GDV. Now, the new land acquisitions alone account for around 14,000 crore. If I've got this right, we pulled out Rabinder, the real estate analyst who we work with, as well as me, when we were looking at the con call transcript, it hinted at around 15,000 crore of GDV. But my understanding, it should likely be more, because there is obviously a pipeline of projects outside of the land acquisitions which they've done, which should also add up to a significant amount of GDV. So I'd want to understand that gross development value number as a whole. Also, with regard to the mix, land acquisitions versus JDA. They prefer JDA in Mumbai, of course, most developers do. And therefore, we'll try and understand what the mix there is. Also, commercial versus residential. And how much of that commercial is recurring revenue is what I'd want to know as well. Because the interest cost itself is at around 600 crore annualized, at least at this point. That will come off. But at the same time, it's well above the kind of 500 crore kind of EBITDA number that they've done, trailing 12-month period. Let me talk about the last piece, the sale and complete projects. I'd want to know as to how that's really stacking up, because there are certain projects where sales haven't come through. I'd want to know whether those realizations and those collections can come in fairly quickly, because completed projects will be the lowest hanging fruit for them. And second is the e-Khata impact. I'd want to know how much and how quickly are we seeing an unwind with regard to that as well. Now, with regard to the company itself, let me try and break this down. It was incorporated in 1986. It's Bengaluru based, and it develops residential as well as commercial projects. It's Bengaluru based, but it has also a presence in Mumbai. So south and west is what it has built a presence around. They also have presence, for example, in Chennai, but south and west is really the markets that they focus on. In terms of the products, they'll quickly come up on your screen. But they have products across the board, from luxury to mid-income to plotted developments. In commercial, they have office spaces, and they also do in-house construction services. That's also something that they provide. And post-sale interior solutions is also something that they provide. So across the board, services are spread. In terms of the FY25 mix, in terms of geography, and that is more important than what kind of service offerings contribute how much revenue. Bengaluru, Chennai is the predominant piece, obviously 73%. 8% is Kochi, again the south-focused market there. And then you have Mumbai, Pune. Really, that's where the balance comes from. In terms of the 5 recent land acquisitions, I spoke about this, contributes around 13,900 crore of GDV to the company. 3 are in Bengaluru with 9,100 crore of GDV, 2 are in Mumbai. Both JDAs, 4,800 crore GDV is what they will likely contribute. And when you're looking at the metrics, at least at this point, broadly, to try and get context and perspective, you'll see realization per square foot is around 9,500 rupees per square foot. In the 9 months, they've done 2.83 million square foot of developable area in terms of launches, around 3.27 million square foot have been completed. So the completion rate is faster than the launch rate, but that is likely to unwind starting Q4 is what I'd reckon. Upcoming projects are at around 15.4 million square foot. Saleable area currently is around 14.3 million square foot. And the total units sold in Q3 stood at 1,116 versus the 250 number same time last year, which is why you're seeing the kind of numbers that they clocked in Q3 were far stronger, which is why you saw the kind of stock reaction you did. Why is that so? Major contributors were Atmosphere, Park Square, Oakshire, Equinox, Capella, all of those 5 out of Bengaluru, and then there is Adora Day out of Goa, which kind of pushed up the numbers for Q3 FY26. Can that sustain is also the question. Now let's look at the last 3 years' performance where Puravankara is concerned. And when you're looking at the last 3 year performance, the top line has grown at a 28% CAGR. So you've seen very strong growth there. But last couple of years, we've seen a flattening out of that. My understanding is that it will start to push up again as execution starts to pick up, which happened in FY24. Let's talk about the 9-month period as well. The top line has grown at 52%. EBITDA has grown at 51%. Excuse me. And PAT, of course, is currently loss-making and therefore not as relevant. But you're looking at EBITDA over the last 3 years, which has gone up at a 12% CAGR rate. So you've seen very good growth over the last 3 years where EBITDA is concerned as well. But of course, it's been choppy. We've seen EBITDA fall off. And in terms of the base, you're seeing a very heavy debt saddle due to which your interest cost is eating into profitability. And therefore, they are currently loss-making in that sense, at least on the P&L account. In terms of the margin trajectory, it's been fairly okay. You've been hovering around the 14 to 21% margin. So it's been choppy in that sense, but it's been okay. We've given this a neutral because you want to see more stability on this number. But I believe that as the revenue base goes up and there's more stability with regard to execution, you'll start to see this number stabilize as well. In terms of the cash flow, you've seen huge negative cash flow, at least for FY25. And that's because you've got an inventory buildup which has happened. You're seeing a decent cash flow increase FY23, FY24. You saw some of the cash flows unwind in FY24 versus FY23. And therefore, as is the case generally in real estate, the unwind happens only on development of the asset. And therefore, we've given this a neutral because in general, the industry faces that kind of structure. In terms of the balance sheet, there you go on your screen. Where is the concern? That's where the concern is. The borrowing number at 4,300 crore negative, or rather 4,300 crore, the borrowing number absolute FY25. In fact, at the end of Q2 FY26, it stood at around 4,500 crore. But the net debt has started to come off, and the net debt, of course, was lower than this. Currently, the net debt is at around 2,500 crore for perspective. But even given the equity value of the company at around 1,700 odd crore, that's still the debt is higher than the equity, which leaves us cautious with regard to how the balance sheet is shaping up. More to be done where the balance sheet is concerned clearly. Now, in terms of the return ratios, they've been single digit, and that's also because of the drag that the balance sheet is doing on the kind of profitability that the company is clocking. But that's really the state of return ratios. As scale kicks in, one could likely see return ratios improve. Very, very likely. When you're looking at shareholding pattern, 75% owned by promoters, so no concerns there. FIs currently hold around 17%, DIs hold around 1%, and the public holds around 67% of the equity of the company. So that's broadly the understanding. In terms of valuations, it's tough to value this one. GDV, of course, is at 15,000 crore. I gave the caveats that I did with regard to that GDV number, but we will quiz management on that as well. There's a large pipeline of projects. Given that it's PAT negative, it's difficult to call. It's a 6,000 crore market cap company. And therefore, that GDV of around even, say, assuming 15,000 crore at 20% margin will likely yield a 3,000 crore of EBITDA if that were to come through. But we'll speak with Ashish Puravankara, the managing director at Puravankara, joining us this afternoon. Ashish, great having you. Let me first set things into context. Let me first understand what is it that the glide path for the debt is going to be like. See, you have the lenders that are lending to you are grade A lenders, right? It's an HDFC. And therefore, there doesn't seem to be a concern. But talk to us about what that does to your P&L, right? It drags your P&L. And that's where the likely concern seems to be. So talk to us about maybe the next 2 to 3 years, where does the debt go?
Thank you for having me. I think it's very
Great having
important to I think it's very important for us to understand on what account has this debt gone up. I'd like to personally evaluate debt in terms of productive debt and unproductive debt. So most of this debt had gone up on accounts of business development, the results of which we're going to see now in terms of some fantastic launches across the west and the south of India, which is close to almost 15 million square foot over the next 6 to 9 months. All these projects are in final stages of approval. There is no huge capital required to take these projects to market. So you're going to see a huge turnaround there. That's point number one. I think point number two, also, if you look at our customer collections, our sales, we have been growing quarter on quarter. So, for example, for the 9 month period, we're already sitting on a cash flow surplus of almost 755 crores. We've seen that gross debt number also come down by almost close to 200 crores. So basically, I think two things. A, as we take these projects to market and put it into production, which will benefit the cash flows, you're going to see that debt number coming down. On the other hand, also when you start seeing handovers, so for example, for the 9 month period, we've already handed over close to about 2,400 apartments. We have another 3,500 apartments which are now we've announced possession for, which should happen over the next 2 to 3 months. That will also aid in strong collections and cash flows. So here on out, at least on the current debt, which was secured for securing some really nice, fantastic projects across the two regions, and as they go into production, you should see that number come down. Also, as a strategy, all the recent acquisitions that we've done, none of them are speculative in nature. So, for example, in terms of a discipline, we're ensuring that from the time of acquisition, within 6 to 8 months, we take these projects to market. So we are also trying to compress the launch timeline from acquisition to launch.
Interesting. Let's talk about the 5 latest acquisitions you've made in this financial year with regard to land bank. Do you believe that? Talk to us about how approvals are falling into place with regard to those, and when do those launch?
So the ones that you're referring to, which is close to about 13,900 crores, which is approximately about 5 projects. 4 of them we should be able to launch over the next 4 to 5 months, and one of them may probably take another month or so.
So then that's large. And can those realizations sustain, or can they just get better given the fact that the tilt is, I would believe it's 2/3 Bengaluru and 1/3 Mumbai. Broadly, that's the tilt. And therefore, should your realizations be materially better than the 9,500 rupees per square foot you're clocking currently?
So currently, like you mentioned earlier in your brief, I think the West contributes about 17% to the total business. But as these projects get launched, you should see that inching closer to about 42%. So you'll have a significant exponential sort of increase in the average realizations for the organization.
And what is, Ashish, give us a perspective on what your total current GDV is. So you've got this 14,000 crore coming from these 5 projects, likely coming in the next 4 to 9 months, if I can call it that. But outside of these projects, what's the kind of GDV you sit on?
So currently, in terms of square footage, just to break it up, we currently have about 32 million square foot under development, out of which I will remove close to 3 million, which is our commercial development. So about 29 million square foot, out of which we've opened up about 19 million for sale. We have sold close to 11 million of that number. So about I think 9 million is what we'll be opening up from that bucket, and the balance will be from the new launches.
Got it. So, roughly 20. So you've got 1.5 million coming in from. You've got 15 million coming in from these 5 new launches which will come through, and then you have another 9 million of existing. So you'll have around 24 million odd. Correct. So you'll have around 24 million odd, and where should realizations go? Give us a hint of that, given that you've suggested that the tilt will happen towards west, which is around 44.55 towards the west now, or whatever, 44.56. towards west now. What should therefore that do to your realization number?
I'm confident. I think with that change in number, realization should be anywhere close to about 35,000.
So that will see a huge spike in your realizations, Ashish. So from
Yes,
sub
because if you
10,000, you'll
look
go to
at
35.
Yeah, because if you look at the kind of projects that we are launching, right? So we have Lokhandwala, which should be in the range of about 45,000. We have Bandra, Pali Hill, which will again, I don't want to reveal the pricing, but that will be significantly higher. The third launch will come from Breach Candy again, which will be a significantly higher number. Then we have Thane as well, which will be closer to a Lokhandwala, a little lower than that. So this will definitely push the average realization for the organization higher.
Okay, and that means that on this 25 million odd square foot, what's the kind of blended that one can expect in terms of realization?
Close to, like I mentioned, I think it should be close to about 32 to 35,000 rupees a square foot.
So that's on the 25 million square foot. Okay, understood. And what is the kind of execution timeline you're looking at for this 25 million square foot?
So typically, I think real estate, larger projects, we take anywhere between 4.5 to 5 years. But we've done significant work at the back end over the last 2.5, 3 years, where we're able to now compress delivery timelines to almost 3.5, closer to 4 years. So almost saving a year, year and a half from the traditional execution timelines. Most projects, I would say 4 out of 5 in the coming years, we're actually excited to, having delivered those projects. We will deliver those projects almost a year in advance from the committed date to the customer and to RERA.
Okay, and that's of course on the 15 million which you will do new, because that will take 4.5, 5 years. That's the full cycle you'll take. On the existing 9 million, how long does that take to fully execute, blended?
On the 9 million, I would say, since most of the infrastructure works would have been completed already with the earlier phases in terms of the amenities, the clubhouse, the common driveways, etc. So I would say anywhere between 2.5 to 3 years.
2.5 to 3 years, okay. So 9 million over the next maybe 2 to 3 years, and thereafter another 2 years to get to maybe 24 million. So the execution will ramp up sharply. How much of this goes in pairing the debt? How much of this goes into new growth capital that comes through? How should one look at debt, and what is the level at which you are most comfortable keeping that number?
So, in terms of, I think, payment of debt, like you mentioned earlier in your brief, I think we have about 800 crores that we will bring down over the next 12 months. Extremely comfortable there. You also noticed in terms of collections, we've been growing almost, I think, 22%, from the previous year. With these launches, we are only going to see much healthier sort of collections. So on account of the existing debt, on account of the existing sales and collections, you'll see that number significantly come down. That said, I think we are in a market of consolidation. We are seeing a lot of polarizing in terms of customers wanting to buy only with the strong branded players. So we are out in the market. We are looking and getting some really exciting deals. So there may be some fresh debt in terms of business development, but the existing debt on account of the launches and sales and collections will come down significantly over the next, I would say, 12 to 18 months.
Ashish, I'm sorry for pursuing this, but what is it that stops you from changing your capital structure? You can very easily issue equity. You're a 75% shareholder in the company, or rather, the promoter group is, and therefore dilution shouldn't technically be a problem. What stops you from doing that?
Nothing really. I think it is on our radar screen, and we are evaluating it currently, and hopefully in the near future we will come to the markets and
Okay.
use that step as well.
That makes a lot of sense. And therefore, let's talk about the gross borrowing number at around 4,500 crore. That should go down by 800 crore plus, probably, if you would do an equity raise, if you opt for that, then that will go down by a further, whatever, XYZ number. What's the number? What's the terminal number you're most comfortable looking at a year from now?
I think so. I think from that gross number, you need to remove. I think the construction finance on account of the commercial asset that we are building, which is close to about 2.8 million square foot. So typically the business model for commercial development is one where you obviously take construction finance for the construction, and as you start leasing, you refi that by way of lease rental discounting, which is at a significantly lower cost, and then the rent collections is what goes towards paying that down. So I think for the sake of understanding, we should remove that. About 650 crores is what is you can attribute to our commercial projects. On the balance, like I said, as this launches happen, we'll see that number come down. In terms of a comfortable number, I think anywhere around one debt to equity is something that we are extremely comfortable with.
Understood. Okay, yeah, that makes a lot of sense. So therefore, if you were to do that, you'd have to likely pay debt by another 1,000 crore odd. I'm just doing the math roughly, Ashish. Right or not, for the benefit of viewers. Now, over and above the 800 crore you're going to do over the next 12 months. Okay, understood. Ashish, with regard to commercial real estate, are you pure play into sales, or are you also looking at retainers, in the sense rental agreements? And how much of your top line, say a year from now, will look at retainer versus one-time sales, not just in commercial but overall, commercial plus residential sales versus the retainer? Just trying to get a sense so that we get a better picture of the P&L.
So currently, I think in the next 2 to 3 months, we should be able to complete two of our key commercial projects, which totals to about 2.8 million square foot. No, sorry, that is about 2 million square foot. So that should be completed in about 2 months from now. We are actively, participating in RFPs for MNCs that are doing site visits. That should give us a rent collection for almost close to about, I would say, 230 crores annually. In addition to that, we have another close to 2 million square foot where we'll be starting construction on. These are, the growth corridors of Bangalore. So very, very exciting locations. Now, in terms of the strategy, projects that we own 100%, the strategy is to hold. The ones where we have joint developments, we will evaluate the opportunistic time to sort of hold it or to exit it.
Okay, Ashish, this has been fantastic. Thank you so much for coming in and breaking this down for us. It's been very, very candid of you to do that. And viewers, that's all the time we have. Sorry. Okay, and that's all the time we have on AAYC. Thank you so much for joining.